All right. Good morning, everybody. We have a lot of data today. They call it a data dump. And we have Powell speaking today too. And I want to stress that he doesn't necessarily have to have an agenda, right? He doesn't necessarily have to come out trying to move the market. Not even, a year ago, his sole purpose would be to not move the market. So I heard some talk this morning. I think it was on Bloomberg, but one of those places that there was an argument that he wanted to send this market back down again. And I mean, maybe he does, maybe he doesn't, right? There's no guidance for this. We don't have a precedent. We can't look back and say, oh, well, the last time, not for this. And it's kind of an uncharted territory. And then there was some discussion that his speech today has been leaked. We may see a little bit of reaction from that. Certainly the Forex pairs have been moving around considerably this morning. On its own, the data today is enough to move the markets. We don't even need Powell, but the fact that Powell is on the docket kind of implies that we're not going to see really big moves until he's had his say. As we do every day, we want to look starting out what happened around the world. This is kind of our chance to get caught up from the overnight hours. Markets from around the world can be affected by what happened during our trading day yesterday, and or they can start the trend and then we kind of pick it up through our trading day. So it's just a really good thing in the morning to see, was any nation closed due to holidays? Did they have any economic agenda on the docket? They have central banks, they have, unemployment, housing numbers. They got the same things we do. So we want to keep track of those kind of things. And they have sectors and industries and sub-industries. And so with China's markets and Asian markets already closed, we want to look back and say, okay, well, what happened last night in the Asian markets? Was housing strong? Was, technology strong? Did they do anything in particular with their currency? Did they put out any statements? So that we can kind of get an idea of where the trend is going. And then that leads us over into the European markets, which are still open, right? It's around noon there now. Think about our noon, our trading day at around lunchtime, and what kind of news we get during that time frame, how the markets respond during that time frame. Well, that's what's going on right now for London, right? Except really a lot of markets around the world close for lunch. Ours doesn't, but other markets, most markets do. Did you want to see what's going on over there? See who's on the docket to speak? Finance Juice is a really great place to do this. You don't have to have an account here, right? You don't necessarily need to have it, but it helps because if you log into the account, you can filter what kind of news you see. This is a news aggregate source. And the sources might not be necessarily something that you want to see every day. So when it comes to what's going on, they do this European market wrap. Europe is still open, but they know that Americans are getting up, so they go ahead and give us an early wrap. If you scroll back far enough, you'll find the Asian wrap. And then if you continue to scroll back, you'll find our wrap from yesterday. And every day after our market closes, they do a market wrap. They also do an early morning kind of heads up sort of thing. So if you look through, say in about 30 minutes, maybe an hour from now, there'll be a post kind of like a little bit of a morning briefing kind of thing, kind of giving you a heads up of what they're looking for. So most of the Fed speakers have been on point. Nobody has stepped out of line. It seems that the agreement is that they're aiming for about a 50 basis point rate hike, and that their target rate is somewhere between 5 and 5.25%. That's the low end of their target rate. And their target rates should be viewed the same way that I talk about looking at trend lines, right? Don't imagine that you're drawing that line with a very sharp pencil, but instead a fat, dull crayon. It's a zone or an area. If they're aiming for 5 or 5.25, that's the low end of their range. But they could, settle into 5.5, 5.75. The better question is, where's the high end of their range? Because if the low end is 5.2, that implies they want to go at least that far. Where's their ceiling? And from what I've seen, it's somewhere around 7, 7.5. Imagine how drastic or extreme that would be. So when they've raised rates this year from basically zero to where we are now, that just got us back in line. This is what they would consider near the neutral rate. Now they want to start moving into restrictive territory. So the question is kind of twofold. Where are we going in the long run? And then how fast are we going to get there? So from 3.75 to 5.25, are we going to do that 50 at a time? Is it going to be 50, 25, 25? Powell's supposed to shine a little bit of light on that today, right? But we don't really know what he's got up his sleeve. But the expectation is that he's going to give us a little bit of guidance on that question. How fast are we going to get to this hypothetical target, and maybe a little more clarity on what the target actually is. So those are the two things you really want to watch for or listen for today, and kind of the reaction that we're likely to get out of it. Don't forget what I had talked about earlier in the week, and that is near the end of the week, we want to have a really good idea of where these two bars are going, right? And I tend to look at it on the week-to-week basis. So, from November 23rd to now, which, we'll be looking at it at the end of the week, is it continuing to grow this bar here, which would be the 475, 4.5, or is it starting to shrink back down again? The 50 basis point rate hike would be this bar here. And if Powell does a good job of pointing everybody towards the 50, then what we're going to expect is that this bar is going to go up and this bar is going to go down. And that's not what we've seen in the last week or two. So, if 50 is the base case argument, it's a little concerning that we continue to see this bar go up. And it shouldn't, right? It should be going the other direction. 5% is kind of priced in if you start looking at these back dates, but the dates aren't set in stone. That's why they're still grayed out. They're not cemented yet. They can change slightly. We wouldn't expect big changes on those dates. So we've got Bowman Cook, and then we've got Powell. Lots of job data. This whole week, we're just going to be getting a lot of different job data. JOLTS is when people leave their job to go get a different job. Grass is always greener kind of thing. Look at JOLTS as the take this job and shove it numbers, right? If there's a lot of jobs out there and people aren't happy where they're at, they'll quit and go to another job. But when jobs are scarce, no matter how bad your job is, you keep it because you're not quite sure you can get another one somewhere else. That's the JOLTS numbers, right? It's a really good way of kind of keeping track of what that one is. Inventories is a really big deal. More and more lately, like yesterday's price action was, a lot of that price action yesterday was energy based, right? In the S&P, the NASDAQ, the moves we were seeing, there was a lot of energy news. So keep your eye on the clock today. It's going to be a really big deal. This is still the range that we're working on. And until we get out of this range, it's the only thing that matters. We can't really take good, solid swings to get into the end of the year until we get this resolved. IX10, we're in the middle of the range. We're in the middle of nowhere. And big picture, we're going to one of those two circles by the end of the year. Now, there is, a third argument that we stay sideways. I find that one really unlikely. Or that we go up first, hit that target, and then go down and hit that target. That's more plausible than sitting still. And it's more plausible that we do that than we only go one direction, because markets don't generally go in just one direction. So those are four different arguments about what we could see out of the market. It's very likely going to start today. This is a big data dump day, but it's not the only data we have of importance between now and the end of the year. We've still got an FOMC report, CPI, PPI. We still got, some really big data points. There was a news report on Apple suggesting that they were going to reduce the lockdowns at the iPhone city, and that could provide a little bit of a boost. I don't see additional auctions today, so we don't really have any of those to worry about. The last one of importance would be the beige book. Farm prices is going to be into power hour. I don't play around in there anyways, so that one's not expected to be a concern of mine. If you play in power hour, keep your eye on the clock. You've got farm prices coming in. That's going to be directly connected to the inflation. So normally farm prices, we would just shrug it like, whatever, it's farm. Yeah. But I'm in Kansas. Farming is important in my area. And if you like to eat, farming is important to you. The cost of goods and services, especially with this rail strike coming back to the forefront, if that rail strike gets more serious, they won't ship farmers chemicals. They'll leave them on the docks because they would be afraid that a shutdown would leave those chemicals stranded in places that would be dangerous, either due to the chemicals or because people could get access to the chemicals. So the cost of those chemicals are going to go up. That changes the cost of food. It's all inflationary. Then the cost of fuel itself, whether you're looking at, gas, natural gas, diesel, gasoline, crude, just energy across the board affects food prices. It's a bellwether for inflation. So in this high data driven marketplace right now, where we're all crunching the numbers and looking really close at all the numbers, those farm prices may have more impact than they normally would. It's worth keeping an eye on. So we're going to be looking for this resolution, this make or break situation coming out of this range that we've been in. And the argument has been, hold the line until the data, hold the line until the data. If he comes out with Operation Don't Rock the Boat, we're not going to leave this box. And then we're going to be dependent on the next thing, right? We'll be looking down the road at the next data point. We need to get out of this box to get anything going. Otherwise, it's just a real awesome theta burn. It's screwing everybody. The bulls are getting screwed. The bears are getting screwed. Anybody with options in a directional play is getting screwed. And the only ones making money are the ones that said, I bet we don't go anywhere. It's a little late now to join the group that says, I bet we don't go anywhere. The wait is nearly over. Seeing the market go this long sideways in that narrow of a range, especially in a bear market, is unprecedented to say the least. We're very likely nearly done. There has been times this year where we've been range bound for, a considerable period of time, or that we stayed, within a candle, IX10 style, but that was a really big candle. It's not much of a surprise when we're inside of a really big candle for weeks and weeks at a time. But this isn't a really big candle. It's a very narrow range, all things considered. So we're winding up. This is pressurizing the market. We are at one of my major levels. It's a quarterly level. And there's not a lot on either side that would interrupt us getting to those two pivot points that I had mentioned earlier. 4140 area, maybe even up into 43 area, and then all the way down into 36 or closer to 35. It's easier to look at it from this point of view. Just put it on the weekly, and those 2 points become pretty clear. So 4,300, 3,500. It's an 800 point range. Split it in the middle. It's about 400 up, 400 down. You can see the volume is a little light this morning, kind of highlighting the importance of the economic events on the docket today. The fact that it's light volume today isn't a concern because, well, we all kind of knew that today was important. The reason I use this indicator is if this was a normal day where we weren't expecting a lot of econ, and we look at the volume and we see it really low like this, that would be concerning, because then it would say, hey, there's something going on and you don't know what it is. Maybe we need to take a look around and try to hunt down why the volume is so light. Or on the other side, if it was really, really heavy and there was nothing on the docket, there was no econ at the time, we would want to go out and try to figure out why the volume was so high. Right. So on a day like this, we don't need it. We already understand. We've got a lot of econ on deck, so we just get it out of the way. It's a really tight range, a very narrow IB. That implies there's still work to do. We've crossed through the pivot point a few times already, so that's done. We're barely up at all, about 0.25%. We have the capacity to move 1.8% today, and we have a market maker move of more than 0.25%. So if you put these two together, it's still not even a 100-point move, but it's not bad. So we can plot that additional market maker move to the upside here. 40.36, you could just add another 12 to that. That put us at 48. So 40.48 and then change 40.49. Well, 40.49 is the previous week's high, so there's no reason to snap a line there. We will just focus on the previous week's high and say that that's where the edge of today's measured move would be. To the upside, obviously. To get there, we would need to pass through the weekly pivot point. When we're below the weekly, we're kind of considered to be in a bearish market. When we're above, we're bullish. But obviously, if we're below but moving towards, then it kind of discounts the idea that we're bearish. Or if we're above and we're moving down towards the pivot, then it's kind of hard to argue we're still bullish. So a rise towards the weekly pivot today would kind of shrug off that bearish bias. And that weekly pivot point is not a handrail. It's not something to lean on. It's not something to trust. It's not structure. It's not resistance. It's more of a milestone or a goalpost. So when we get there, we don't really expect price to respond to that pivot point. To get to that point, we would have to get through the cash high of yesterday. So resistance at 39.80. And then the entire high of yesterday, 39.90. The ADR half at 4,000, which, by the way, is still the gamma 0 level. If you keep track of tier 1 alpha, right, that's their gamma 0 location. Then the weekly pivot, then the ADR full, then the market maker move added to the ADR. For the downside, our own Globex low, 39.56. The full low of yesterday, 39.41. Last week's low, 39.37. ADR half, 39.24. ADR full, 38.87. And then put another 12 on that. So from 87, take 10 off, that's 77. Take 2 off, that's 75. Get rid of the change, call it 73. So 38.73. I don't like the 3. I'd rather go with a 5. So 38.75. That's pretty darn close right there. It might seem like a long ways away, but we're not reaching even a little bit. That's well within our boundaries today. We wouldn't even consider this a big move. That would just be normal. If we want to see what extreme looks like, we would take this entire distance, divide it in half, and then add it to the numbers that we've already got. So, just trick it all out and say that today is a 2% measured move. Add another 1% to that and measure out a 3% move from the close. The market has made more than one day of 3% moves this year. And we've had more than 10 2% moves this year. So making a 3% move in a single day, that's not a big deal. There's still no expectation that we're going to go that wild and crazy and extreme today, but that's often when we do make those kind of moves, right? When it is a surprise. The only argument that I have for suggesting that we don't go that far today is, well, everybody is thinking we could, right? And that's when we usually don't. So the more expectation of a big move we have, the less likely it is that we're going to get it. Because it's usually the surprises that drive those big moves. I'm going to show the FX markets and we're going to talk about them in a little bit. But the main thing right now is that keep your eye on finance. Is just the narrowest way to say it. When we look at the NASDAQ on a day-to-day basis and we look at the S&P through the day, advancing and declining issues and what's going on in cumulative tick, cumulative volume, and advancing and declining issues, the number one takeaway between those two markets is the NASDAQ 100 does not have financials and the S&P 100 does. They both have tech. They both have, a lot of the same names in it across the board, but they don't share financials. So yesterday, if you look at the advanced decline on the S&P, we had a little bit of a bump near the beginning of the day, but by 11 o'clock, that was done, and it basically stayed range bound for the rest of the day. The NASDAQ, on the other hand, dropped down about 50% and then kept that through most of the day. Remember, the only major difference between these two is financials. Yesterday, we had tech and finance basically working together, which is pretty nice. And I say tech, but I mean big tech. This is NY Fang. So it's a representation of mega market cap stocks, the big dogs. Not necessarily, quote, tech, right? For tech, we would want something like XLK. Now, if you look at XLK yesterday, and you look at finance yesterday, you see the difference between these two. These two are supposed to be working together as a group. They're both risk-on sectors. Yeah, that don't look the same to me now. So keep your eye on finance today. Continue to watch Apple. It is the darling of Wall Street. It's one of the few that has not been beat down yet. And if it really starts to fall out of bed, it's going to take this market with it. So keep your eye on finance. We still have that weekly gap that needs to get closed. We'll focus on that at some point. Just keep your eye on that today. If we do make moves to the upside, 40.34 is one that you're really going to watch, right? So 40.34 is up near the ADR full. We get close to that, it's going to become a magnet, right? Like a gravity source. We will go to it. Now, how close is close enough? Yeah, it's kind of arbitrary. I would say once we get above where we opened on Sunday night, that would put us into the channel. And once we get into that channel, especially starting from our current location, we would gravitate towards Friday's close. Yeah. All right. So earlier in the week, we talked about being at the top of the box. When we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. We've been doing that. I've been working our way down towards the bottom. Nothing says we actually have to get all the way to the bottom. On Thursday, well, on the other side of Thursday, as we get into Friday, we're going to lose this data here, which will make that the bottom of our volume profile. And at which point, we will have been to the bottom already, and it will be working its way back up again. It's hard to articulate that this volume profile is not going to stay where it is. We look at it once a day as a snapshot of this moment in time. And it seems like every day volume and price within this volume profile has been moving down. That's not necessarily what's going on. Each new candle that prints on the right side takes a candle off the left side. That might seem like an obvious statement, but it moves these yellow lines. It moves the volume control. So price can end up at the bottom of the box, not because price moved, but because the box moved. The easiest way that I could get someone to grasp this for themselves is if you was to take a picture, say, take a picture of what it looks like now, and then tomorrow, take a picture, and then the next day, take a picture. And at the end of the week, go back and look at each of those pictures side by side. And what you'll notice is this entire volume profile moves. Even if price didn't, the profile itself moved. So yeah, we're working our way towards the bottom of the box, but the bottom of the box is also rising up to meet us. If we break the low of yesterday, there's nothing really helpful volume-wise. You know, it's like we just got a big air pocket of risk underneath us. Should we break above Tuesday's high, we should be able to get to that gap close, at least get into the channel for the gap close relatively easy. There's not a whole lot of volume. Just watch that 4011 area. It's the cog line. That'll be your last major level of resistance. You get through that, should be able to get into the channel fairly easy. Five-day, 5-minute, each day having its own volume profile. This is where we get a chance to carry forward the VPOC, if there is one. And we have one overhead at 40.35. That's a level we've talked about already, right? 40.34 is the gap close that we're aiming for. 40.35 is what I just mentioned for a VPOC. That thing will act as a gravity point. It's another reason to believe that if we start to get inside that channel, or if we do get inside the 40.20 channel, we're very likely going to 40.35. All right, this is distance from moving average. Which, by the way, Thinkorswim already had an indicator that did this, right? Theirs didn't have all the labels and it didn't look like this, but they already had an indicator that was asking how far away price was from a moving average. I just took that and pimped it out a little bit, right? Put spinners on the rims. We're barely below the 10-day. So we're in the center of the basketball court. Price right now has the capacity or the distance to move in either direction a good 3.5%, 4% from a moving average. That's really important to keep in mind, especially when we're considering that we've waited here for 3 weeks, waiting to get out of this range that we're in, IX10 on a weekly. So when we do break the range, this says we're not overbought, we're not oversold, the market's not extreme, it's not tired, it's not exhausted. It doesn't have a low inertia. It's ready to go. Distance away from the 10-week, we're still above it. About 1.4%. That's not too bad. It's a little high, but it has plenty of room to run. At least another 1.5%, which would put it around 3%. We could easily overshoot that. So distance away from 10, looking at it on a weekly point of view, there's still plenty of room. And it again brings in that argument that says, once we break this range, we have the capacity right now to make some really big moves. And those moves would not be overbought or oversold or extreme. All right, so we're looking at US dollar China. We've seen here some pretty big moves. It finally broke that quarterly level. We had a significant drop to the downside, kind of getting tangled up around my monthly lines. Got these minor weekly levels. But 706, 705 half is kind of the next target. And it doesn't really matter that you want to trade Forex or that you quite understand Forex. It's the idea that this directly impacts normally what's going on in the Dixie, the DXY. And the DXY directly affects the S&P and the NASDAQ normally, right? So if everything's working the way it's supposed to, this going up would be dollar-led, because dollar is the first name in this pair. It's US dollar China. So if this goes up, it says the dollar is stronger than the won. If this goes down, then it says the dollar is weaker than the won. So when this hits a support level and bounces off a structural level, that's the dollar going up. Yes, this is going up, but we would very likely expect to see the dollar go up. And if the Dixie goes up, the S&P and the NASDAQ is going down. It's just a little deeper insight on the Dixie, right? Because if you're just sitting there watching the Dixie and trading the S&P, and you see the Dixie suddenly turn and flip, and you say, why'd the dollar do that? I didn't see that coming. And of course, if the dollar flips, the S&P flips, it shakes and rattles everything, stops you out of your trade. And it was, oh, well, I didn't see the dollar was going to make that kind of move. So this is just one step farther past the Dixie, right? Past the DXY. It doesn't have to be this pair, by the way. But with the manipulations and the shenanigans going on, where the state banks have been caught, heavily dollar swapping. If you were to search, you can find Reuters articles where, October, a little bit in September, some of November, that the banks have been caught either swapping dollar for yuan or vice versa in big quantities, getting a heads up because they had to buy the ADRs. The state banks were told, get to buy-in. Do searches on that. You'll also find articles from New York Times, Bloomberg, Reuters, that the banks were ordered to buy the stocks, whether they like it or not. They had to buy. They need the dollars to do that. So we've been watching US dollar China for that, but we've been watching US dollar Japan because they're at a real critical level where they had to do state intervention. And that's a rare thing. It doesn't happen very often. And they were threatening it and posturing it, and then they finally did it twice this year when they haven't done it in decades. Drastic extreme moves in this is going to cause drastic and extreme moves in the dollar, and that's going to cause drastic and extreme moves in the S&P and the NASDAQ. So it's worth watching this. The thing is, this morning, today, we just seen US dollar China. That was a pretty big move that we were looking at this morning. The dollar didn't respond. The S&P and the NASDAQ didn't respond. And that should be a little bit concerning. Here's the Dixie this morning. And there's no big move here. A little bit of move, but nothing extreme. Nothing like we saw in that US dollar China chart. The US dollar China chart is also going to directly affect commodities and metals and energy. US dollar Japan is going to directly affect gold and silver. So for you gold bugs or you silver traders, that's one to watch, right? Inverse correlation. So US dollar Japan go down, gold, silver go up. So we're seeing a little bit of move this morning in the dollar. It's not extreme yet, but it is starting to break down literally while I'm talking, starting to break a level here. Coming right up into one of my structures. We're looking for the dollar to find support and bounce. You can see how this move down in the dollar is directly inverse of this move up in the S&P and the NASDAQ. That's why it's really worth watching to kind of get an idea of what's going on out there. And then try to confirm that with moves in the VIX, right? If the dollar dropping down is bearish, or if it's bullish, you know, if it's moving up, it's moving down. The move that you see in the dollar, you should be able to directly see in the VIX as well. So the S&P and the NASDAQ going up should see the VIX drop, should see the dollar drop. And I say should because if you don't see that, then it's a heads up that something's wrong, that something's not doing what it's supposed to do, or that the move is coming from a different direction. Because the algos can respond to things other than a dollar move, right? It could be news-based. It could be a million different things. Keep in mind with this move that we've got today unraveling right now, and with all the econ on deck, it still doesn't mean anything until we get out of this range, right? Everything comes down to this range right now. So moves up, fine. It's still going to stop at the top of the range. Moves down, great. Maybe we'll wick out, but we're still going to stop at the top of the range, the bottom of the range, until Powell, right? All right, nat gas is down slightly. Nothing else is remotely close. The benchmark is 0.5%, and I don't have anything down even 0.5%. So we want to flip this over and look at what's up this morning. KWEB, which is China names, Bitcoin, emerging markets, which again, China names, gold, energy, gold, biotech, some more energy, uranium, so more energy, solar, more energy, metals and mining. It's what we would expect, right? US dollar Japan going down, metals, mining, gold, silver go up. the sectors of importance, XLF, XLK, those aren't up enough to be impactful. All right, we got a little bit of a gap up in Tesla. So all the FANGs, well, not all of them. Apple, Google, PayPal, Tesla. So we've been focused a lot on the S&P, but as we get through this range that we've been in, you really want to think about the reverberations or the echoes that it's going to give across the market and some of the bigger names that you can play to kind of take advantage of this situation that we're all focused on. Now, Tesla's started to give it all back, right? It hasn't completed the move yet. There's still a lot left to go. Tesla's one that has room left. Apple's one that's got room left. Microsoft. So especially Apple, right? Out of all the names that we have, you can see how Apple's still holding nicely, strongly within that top area on the chart. How close from the high is it, right? As opposed to names, say like Facebook or PayPal or Netflix. These are the last names of the greats, right? So we need these to go before we're going to finally get that reset. They're not going to go easy. It's not going to just roll over and dump, just all nice and simple. But as long as we're maintaining within those benchmarks, it should be fine. So for Apple, that benchmark that we want to focus on would be 156 versus 127. And if you want to take that out a little bit bigger, the reason we can't really use this 177 is it's just too close to the top, right? We need one closer than that. So call it 155 for some easy numbers, and 130 on the downside. That's a 25-point range. And as long as we're sitting in there chopping back and forth, we're not going to really get anywhere else in the market. Now, Apple had a significant gap down. This is a really big deal on a weekly. And it's not done yet, but that's a real negative for technical analysis, right? This rollover and this really big gap down is a big deal, especially since the gap isn't filled. You see how this gap up here, it got filled. It took 3 weeks, but it finally got filled. This one is not filled yet. But we're likely not going to fill that one, anytime soon. Now, Microsoft, on the other hand, it opened gapped down, but not by much, and the gap's not filled, so that's still on the table. The violence that we see this week, as we get more of this Econ, we could go in both directions, up and down. We could very easily run up, tag that, get it closed, and then continue the dump. This is a really tight IX10. Notice how just absolutely different it looks compared to Apple. Really strong still, and a lot of room left to the downside. Apple's got more room to the downside, but it's making that move. I'm short Microsoft. One of the benchmarks you can use is this really big green candle back here. Just divide it by quarters, 50%, 25%, 75%. The next target to the downside right now is 234. Then 227, and then 221. All right, I shared this chart yesterday where I went through, laid out all the levels, and I brought in the tier 1 alpha levels as well. Those are pretty much the only things they're going to update. These daily and weekly moving averages, they might need slight adjustments, but otherwise they're fine. And that's just going to leave pivot points behind after that. Now, I shared this chart before the market opened, so it's not like I went back later on and drew all these lines. But look how price responds to the lines that are there. There is an old argument that says if you draw enough lines, price is determined to hit one of them at some point, right? And I hate that argument because it kind of makes you feel like you're wasting your time with the lines. But just keep in mind, these lines aren't necessarily a tradable situation, right? It's not like I'm going to go short just because it got to that level. Not by itself, but they are goalposts, right? Benchmarks that we got to that level, and now we're looking for the next level. How far, how fast we got there, how price responded when we got there. What's the next area from there? The 5-minute open range is a pretty popular strategy. You can use a 5-minute open, a 15, a 30, a 1 hour. When I first heard about the strategy, it was in an old book that I found at the library. And they were using 1 hour open range, mostly because back in the day, they didn't have the data to do 1 minute, 5-minute, 15-minute. It was just too expensive. You had to pay thousands of dollars to get that kind of intraday chart data. I've used them all. They're all fine. A lot of the 1 hour opening ranges will still be the same opening range as a 5-minute or a 15-minute or a 30-minute. It's just the way that it works. So you can pick whatever one you want. One of the things I recommend about the 5-minute open range is to measure it out and then plot 100% of that move. So here's the 5-minute open high and the 5-minute open low, right? That first 5-minute candle. Once you've measured the open from high to low, plot that thing out 25%, or excuse me, 50%, and then 100%. You can do it both directions. If you're not quite sure which way it's going to go, plot it both directions. What you're going to find is a lot of times the market will make that measured move, and then that's all it's going to make. So yesterday, when it made that move to the upside, it made 50% of the move. It stalled there. It couldn't get past it. And that was the rollover place. Surprisingly, you can go back day after day after day in SPY, not SPX, but in SPY. And you can measure out that 5-minute candle. And I think you would be surprised at how often price got right to that measurement and stopped. Maybe not to the tick, but remember, when you have a pivot point, price isn't supposed to stop right at the pivot point. It's supposed to go beyond the pivot because liquidity exists on the other side. So if price goes up and stops and drops and doesn't get into that, then it never got to the liquidity. All right, so this morning, really keep your eye on the FX pairs and the dollar. We've got a lot of news, so just be very cautious about a market flipping over. The market breadth that we generally use on a day-to-day basis will not be useful today, right? All this data is going to just continue to push the market around, especially if the data is conflicting, right? If we get bad data on one data set and then good data on another data set, and we're all still waiting on Powell, so we could get a lot of violence and moving around, but until 1:30, none of that violence or moving around should stick, right? We shouldn't get a dominant thesis in the market until he comes out. So just really keep that in mind, right? If you're taking trades through the morning, lock in gains, lock in your profits, be ready to see this market flip over on a dime, and keep your eye on the clock. It's going to save your butt. It gets you out before, big shifts. And where we close on the day is going to be a lot more valuable than where we move today, right? Just moving around isn't enough. So with the S&P, a little bit of the NASDAQ, but benchmark the S&P. We want to resolve this range. We want a really good answer. If we're going to get above that 40.25 or that 40.30 level and begin pressing to the upside, or if we're finally going to break down and get out of this weekly box that we've been focused on. We still have that weekly expected move. $4,100 is the top of the box for the week. And $39.50 was the low end of the box for the week. $3,800 is where things would start to get a little extreme. If we get to $38.50, it's very likely the algos will start to sell into selling because they'll need to get back to delta neutral, and that's the way that they do it. They'll trade options like they always do on a week-to-week basis, building their strangles and straddles on one of these lines. And then to protect that, they get delta neutral using the futures because futures have a hard delta. $4,200 would be the starting point for buying into buying. So if we break to the upside, which is not likely to go that far, but if we break to the upside and we get above 4,100, 42 is where they would start to buy into buying to get back to delta neutral. So we got the extremes. We got our levels. We're ready to go. All we got to do is get Powell out there and see what's his agenda, right? Is it going to be a Jackson Hole mic drop moment, or is it going to be more of Operation Don't Rock the Boat? Everybody have a good morning. I'll see you all tomorrow.